So much of the investing world is obsessed with the what. What's the hot stock? What's the best fund? But honestly, the question that's way harder, and maybe even more important, is when. When do you actually pull the trigger? So let's get into it. Today, we're going to build a framework, a way of thinking that goes beyond just reading a company report. We're going to look under the hood, at the economic machine that's actually driving everything.
Okay, let's imagine this for a second. You've been doing your research, right? And you stumble upon this bond fund. It's yielding a juicy 9%. Looks solid, diversified, pays you every month. I mean, on paper, it's a total home run. But here's the real kicker. The question that everything hinges on. Should you buy it today? And this is where things get really interesting, because that 9% yield is a total paradox. Take the exact same fund, offering that same 9%. If you bought it back in 2007, you were walking straight into a 40% haircut on your investment, a total collapse. But if you waited until early 2009, that same 9% yield was your ticket to a 60% gain. Think about that. Same fund, same yield. Completely opposite results. It's wild.
I mean, just look at the sheer scale of this swing. From late '07 to the bottom in March '09, these funds just got hammered. Total crater. But for the people who had the nerve to jump in during the absolute peak of panic, and I mean, when the market's fear gauge, what we call credit spreads, was screaming at an insane 2,200 basis points, well, their reward was huge. It just goes to show you, timing was literally everything.
So what does this all mean? Well, it means the answer, the thing that would have saved you or made you a fortune, it wasn't buried in some 100-page prospectus. Nope, it was right there, out in the open, in the signals the economy was sending. And learning to read those signals, that's the whole key to figuring out the when.
All right, so to really get a handle on the when, we've got to start with the basics. We need to understand how the economic engine actually works, because this is the machine that ultimately decides if your investment takes off or, well, takes a nosedive. At its very core, the economy is actually pretty simple. It's just a big circle. Your spending becomes my income. My spending then becomes somebody else's income, and on it goes. For the whole thing to actually grow, you really only need one of two things to happen. You need more people working and spending, or you need each of us to get better at what we do, more productive. That's the foundation.
Okay, but here's where the secret sauce comes in. It's credit. You can think of credit as the accelerator pedal for the entire economic engine. It lets us do something kind of magical. It lets us pull our future spending into today. Right? A mortgage lets you buy a house now, not 30 years from now when you finally saved up enough cash. Credit just pours fuel on the fire.
And look, this isn't just some abstract theory. The legendary Howard Marks puts it perfectly. The flow of credit, the willingness of people to lend and borrow, has this incredible, almost gravitational pull on the price of assets. A tiny shift in the economy can cause a massive change in that willingness to lend. And that's where both the biggest risks and the biggest opportunities are born.
So, if you're buying a bond fund, you're basically a lender. And as a lender, there are really two big dials on the dashboard you absolutely have to keep an eye on. First up is inflation. Why? Because it just eats away at what you're actually making. That 9% yield doesn't look so hot if inflation is 4%, right? Your real return is only 5%. And second is employment, because when people start losing their jobs, they stop paying their bills. It's that simple, and that's what drives defaults.
Okay, so we've got the engine, but how do we actually read the signals it's putting out? Especially the signals from big players like the Federal Reserve. This is where a lot of people get into trouble, because they don't account for this one critical thing, the lag. And it's a lag that can absolutely wreck a portfolio.
This is such a crucial idea to get your head around. When the Fed does something, say they start hiking interest rates like they did back in March of 2022, the real impact isn't felt the next day. It's not even felt the next month. It takes a long time. We're talking 12 to 18 months for that change to work its way through the entire system. So reacting on the day of the announcement, that's almost always a mistake.
Now, one of the most powerful signals out there is something called the yield curve. It sounds complicated, but the idea is pretty straightforward. When the curve inverts, which just means it's more expensive to borrow money for a short period than for a long one, the market is basically screaming that it sees a recession coming. On the flip side, when it's steep, everyone's feeling pretty good about growth. It's not foolproof, of course, but check this out. Every single U.S. recession since 1970 has been called by an inverted curve first.
This all leads to a really important distinction you have to make. Are you looking through the windshield or the rearview mirror? Leading indicators, things like credit surveys or the number of people filing for unemployment for the first time, they give you a hint of where we're headed.
But lagging indicators, like the official inflation numbers or default rates, they only tell you where we've been. And by the time those lagging numbers confirm there's a problem, well, the damage is already done.
And this is the pivot. We have to let go of the idea that we can perfectly predict the future. We can't. So instead, we shift our focus to something much more achievable: preparation. Howard Marks says it perfectly. The goal isn't to know exactly where we're going. The goal is just to have a really good sense of where we are right now.
So, how do we get that good idea of where we are? We don't need to get lost in a sea of data. We just need a simple dashboard, a handful of key dials to watch. So let's build one. We'll call it the Lender Creditors Dashboard, and it's built on just 6 numbers that can cut through all the noise.
And here they are. These are the 6 dials you need to watch. 1. The yield curve. That's your recession warning. 2. Credit spreads. That's the market's fear gauge. 3. Inflation. Is your return real? 4. Unemployment. What's the risk of people not paying their debts? 5. A financial conditions index. This bundles a bunch of stuff together to tell you if money is easy or hard to get. And finally, number 6, Fed policy. Where is the big ship being steered? That's it. These 6 things together give you an incredibly clear picture of the landscape.
And as you're looking at that dashboard, every piece of information gets filtered through one simple but incredibly powerful question. This is really the heart of the whole framework. You have to ask yourself, given everything I'm seeing, what could go wrong? And is the return I'm being offered today actually enough to pay me for taking on that specific risk? If the answer is no, you simply wait. Okay, let's bring this all home. This is where we move from theory to practice. We're going to take our dashboard and our core question, and we're going to use them to position our portfolio. Again, the goal here isn't to predict, it's to prepare.
And this is how it plays out in the real world. So picture a late expansion. Your dashboard is showing an inverted curve and really tight credit spreads. Those are warning signs, right? The risks are high, but the potential rewards are low. So what do? You get defensive, you become more selective, and you build up cash. Now flip that. Imagine we're in a recession. Fear is everywhere. Spreads have blown out wide. Your dashboard is now telling you that you are finally being paid well to take on risk. That's your signal. That's when you step up and put that cash to work.
You know, having the map is one thing, but having the discipline to actually follow it, that's the hard part. It means you have to be patient. You have to wait for a few different indicators to start telling you the same story. You have to respect that time lag from the Fed. And maybe the hardest part of all, you have to demand to be compensated fairly for the risk you're taking. And if the market isn't offering it, you need the confidence to just step aside and wait for a better pitch. And let's be really clear here. This is not some magic formula that spits out buy and sell signals. Investing, as Howard Marks so bluntly puts it, isn't supposed to be easy. This is all about developing a deeper, more thoughtful way of understanding the world you're operating in. It's about second-level thinking. Which brings us right back to where we started. The goal was never to predict the next market crash to the day. That's a fool's game. The real goal is to build a process, a repeatable framework that helps you prepare so you know when it's time to play defense and you have the cash and the courage to play offense when everyone else is running for the hills. So let's go back to that first question, that 9% yield. Now that you have this framework, the dashboard, that core question, an understanding of the cycle, how does that 9% look to you now? The answer, as you now know, has almost nothing to do with the number 9 itself and everything to do with the context that surrounds it.